If you watched the previous video, we just finished recording a bunch of transactions for a business, and now we're going to use that information to analyze the company's balance sheet. Now, this should be a review from the previous video. The results of the transactions that we recorded are listed here. You can see, and this is just a little bit of a reminder, a little bit of a review. Cash is an asset account. Assets normally have a debit balance. So what we're seeing here, if you were to add up all these debits, combine them, that's $30,000, and then add up all these credits and subtract them from the $30,000, this cash account has a net debit balance of $20,700. That means that we have a positive cash balance at the end of the accounting period, $20,700. We should expect to see that $20,700 on the company's balance sheet as of the end of the accounting period. The same is true for inventory, which is an asset, and equipment, which is an asset. These are all things that the company owns. Flipping over to the other side of the accounting equation, we would expect that liability accounts have a credit balance. Remember that debit does not necessarily mean plus or minus. Credit does not necessarily mean plus or minus. It depends upon the type of an account. A credit balance over here for an asset would actually mean negative asset. A credit balance over here for a liability is normal. It's a positive liability. This is telling us that our balance sheet should report the fact that we owe $10,200 to our vendors. That's a current liability. We owe $20,000 to somebody that loaned us money, probably a financial institution. These are positive balances. And then over here, the only owner's equity account we have, stockholders' equity in this case, common stock. And it's normal for an owner's equity account to have a credit balance. These T accounts right here are going to be the building blocks for our trial balance, and then we're going to use that trial balance to illustrate a balance sheet. I do want to point out that the effects you're seeing here, we had a beginning balance of 0. Then we had a transaction that caused cash to increase by $10,000, increase by $20,000, decrease by $300, decrease by $5,000, decrease by $4,000. What you're seeing inside the T account are the individual transactions that are affecting that account. What you're seeing at the final bottom line are the ending balances in those accounts. So we can take the results from these T accounts and we can actually post them into something called a trial balance. A trial balance is simply a collection of the company's accounts and their respective balances at any particular point in time. So here's the $20,700 cash balance. It's a debit balance, so we have to put it over here with a debit in the column. The same is true for the $600 right here for inventory, the $18,900 for equipment. Okay? And when we turn the page in a minute, we'll see how the liabilities and the stockholders' equity account feed into the other side of the trial balance. Over on the other side of the trial balance, just as an example here, the net balance at the end of January for accounts payable, $10,200 credit, and that's listed over here with $10,200 credit. So basically, the trial balance is simply a collection of the accounts that the company uses to record its financial transactions, and whatever debit or credit balance happens to be the ending balance for that account as of that particular point in time. You will notice it's called a trial balance. What that means is that the total of your debits will equal the total of your credits. Now, with modern computing software, it would be virtually impossible to have a situation where your debits do not equal your credits, because the software simply will not let you post an unbalanced entry. Of course, it could happen, I suppose, if you had some kind of override over the software. In the days when we had paper and pencil financial bookkeeping, having this trial balance was actually a very important mechanism to make sure that we had captured all the transactions, because if you forgot to post one side of a journal entry, maybe you posted the debit to cash, but you forgot to post the credit to accounts receivable, your trial balance would not balance. It was a way to check your errors. In the modern era, we use the trial balance as the basis for preparing the financial statements. It's time for us to discuss the concept of a classified balance sheet. And let me just explain what classified means. It means that we take our assets and our liabilities and we classify them into current and non-current portions. Sometimes you'll see current and long-term, or sometimes it's just current and then it's assumed that people know that if it's not current, it's long-term. But the basic concept is this. Take the assets, for example. We want to know which of our assets are going to be available in the terms of cash or to become cash or will be used up within the next operating cycle or the year, whichever is longer. We'll talk about operating cycles in just a moment. But the takeaway at this point is basically these are the assets right here that are going to be either our cash, will be converted to cash, or will be used up or consumed within the next 12 months or operating cycle in the near term. Whereas these assets down here, the $18,900, that's equipment, that's furniture, fixtures, ovens, computers, things like that, that we intend to use in our business year after year to conduct our operations. These assets right here, the equipment, this is not expected to be consumed or converted to cash in the near term. So we separate the timing of the assets, and that will help us assess something called liquidity, which we'll explore in a few minutes. On the liability side of things, we do the same kind of thing here. Current liabilities, those are the liabilities that we're going to have to pay in the very near future, 12 months or the operating cycle. Whereas this liability down here, this note payable, kind of like your home mortgage, apparently that's not due until maybe a year, 2 years from now, something like that, something beyond 1 year. You can start to see the building blocks of being able to assess a company's near-term and long-term cash flow. If you were to take these current assets of $21,000, compare them with the current liabilities of $10,200, what you're seeing is we have economic resources in the near term that are roughly double the obligations that we're going to have to settle within the near term. This helps us assess the amount, the timing, and the likelihood of future cash flows. We've taken this trial balance and we've used it to create this balance sheet. Now what we're going to do is we're going to talk a little bit about what an operating cycle is, because that's so critical for making the distinction between current and non-current. And then we'll move into some analysis of the balance sheet. Before we leave this balance sheet and look at that operating cycle, there are a couple of concepts I want to make sure that you understand. First of all, this classified balance sheet is a very simplified balance sheet. And I kept it simple just for illustration purposes. Okay, many accounts, for example, accumulated depreciation is an account that we would normally see here with equipment. It's not there. I don't want to muddy the waters with that concept yet. We'll do that in a later lecture. Retained earnings is a component down here of stockholders' equity. It does not yet exist for this brand new entity. Again, retained earnings, it's kind of its own confusing animal. I wanted to leave that out of the picture. So I just want you to understand that what you're seeing here is a balance sheet, but it's an initial balance sheet for a brand new entity that has not conducted operations yet. So there are some things that we will eventually see in a balance sheet that you're just not seeing here right now. The other thing that I want to point out here is that there are no debits or credits listed here. One of the things I sometimes see is students might want to, because sometimes people will put like totals here and some subtotals over here. Sometimes students get tempted to put debit and credit or something like that. The people reading this balance sheet, they don't want to see debits and credits. They may not even be accountants. They may not know the debit and credit rules. So even though behind the scenes, you know that the bookkeeping would suggest that, yep, these are debit balances, debit balance right here. Over here, we know that these are all credit balances because they're liabilities and equity. The words debit and credit, or the abbreviations, don't appear anywhere in the balance sheet. It's just the amounts and their balances at that point in time. Because these asset accounts are debits, they're positive. And because these liability and equity accounts are credits, they're also positive. We don't need the bookkeeping terminology on there. The external users simply don't want to see that. We know the operating cycle is an important concept because it helps us determine which assets are current and which are non-current, and which liabilities are current and non-current. An asset or a liability is current. Well, let's start with assets. Current assets are expected to be already cash, converted to cash, or used up within the operating cycle or the next year, whichever time period is longer. And current liabilities are expected to have to be paid or satisfied within the next year or operating cycle, whichever is longer. Now, for a lot of businesses, 12 months is plenty sufficient for an operating cycle. Let's explain what an operating cycle is. The operating cycle starts whenever you spend cash to start whatever it is you're in business to do. Let's think about maybe a manufacturing company. So when a manufacturing company starts to spend cash, they might have to initially pay for raw materials. Okay, so components. And that would be spending some cash. They may also have to pay their employees. Again, we're spending cash. They may have to pay, whatever other operating expenses. Okay? Again, this requires cash. So what we're seeing is the operating cycle begins when the company pays cash to begin its operations. Cash is going out the door, and eventually then what happens is, in this case, it's a manufacturer, so they're going to manufacture their product, and then it doesn't become cash yet because it's going to get held down here in inventory. Okay? That'll show up a little bit better right here. So now that product is staying in inventory, we're waiting for a customer to purchase it. Finally, a customer comes along and they purchase it. And you would think that we would suddenly have some cash coming in. But a lot of times we extend trade credit to our customers in the form of accounts receivable. So just because we manufactured a product, we stored it in inventory for a while, eventually sold it to a customer, we still haven't received payment. The cash cycle, the operating cycle ends once we receive the cash from our customer. So we have to wait for that payment to be collected from the customer. The operating cycle begins when we spend cash and we go all the way around the cycle. It ends when we finally collect the cash from our customers. A lot of businesses have short operating cycles. Think about a local restaurant. They're going to have a pretty short operating cycle because they pay for ingredients and other supplies, probably use those ingredients and supplies very quickly, sell to customers, collect the cash. Operating cycle might be a week or two or something like that. Other businesses may be a little bit longer. Think about an automobile manufacturer. They may have an operating cycle that's a couple of months long, something like that. But some industries have really long operating cycles. Think about a company that is in the business of building cruise ships, these behemoths, these floating cities. It may take longer than 1 year for that company to spend money and finally collect that money from its customers. That's why, for the most part, we're going to say a current asset is expected to be collected within 12 months, converted to cash within 12 months, or used up within 12 months. And a current liability is expected to be satisfied or paid within 12 months. For purposes of what we're doing in this class, use the 12 months. But do understand that for some businesses, in certain industries, the current assets and current liabilities may be measured against a yardstick that is longer than 12 months. Please remember that external financial statements are supposed to help users assess the future cash flows of the enterprise. This doesn't mean that it's going to be a perfect prediction. Nobody has a crystal ball. It's not a guarantee. But the financial statements do give us information that we can use to make our own assessments about how much future cash flow, when will the cash flow likely occur, And how likely is it that we actually will see that cash? Or will the cash have to leave the business, either coming in or going out? What I want to focus on with this analysis of the classified balance sheet is the timing. The classified balance sheet allows us to assess the timing of future cash flows by dividing the assets and liabilities into current and non-current portions. The gateway ratio is really the current ratio. It's not the only ratio used to assess liquidity, but it's probably arguably the most common. Let me explain liquidity for a minute too. A liquid asset is like water. It flows easily. So it flows easily from one entity to another. If you owe somebody money, they're going to want to get paid in cash right here. Right? They're going to want cold hard cash in most circumstances. So when we're assessing the liquidity of a company, what we're doing is we're really saying what kind of cash or resources close to cash will the company have in comparison to its current liabilities. And liquidity is really assessing the short-term health of the company. You can think about it this way. How likely is it that the company will remain in business for at least the next year? Short-term health of the company. Later on, in a different chapter, we'll talk about solvency. That's really the long-term health of the company. But for now, we're just worried about, can we get through the next year? So the current ratio measures the magnitude of current assets divided by current liabilities. Let's just work it out here. Our current assets are $21,300. Current liabilities over here are $10,200. The math isn't particularly difficult here. It comes out to 2.09. Let's start to talk about what that means. That means that we have current assets that are double our current liabilities, a little bit more than double. So that means that we could have some kind of unexpected contingency happen, and we'll probably still have a very good chance of being alive for the next year. A current ratio of 2 is a pretty healthy current ratio, but I would like to caution you this. You have to take a look at not only one company over time. So current ratio of 2 might be good, but what if your current ratio used to be 3.0? And even before that it was 4.0. All of a sudden, a current ratio of 2 really doesn't look quite as good because we used to have 4 times, 3 times. So you have to look at the same company over a number of years and look at that trend. The other thing you have to do is look at industry benchmarks. This is a coffee house. You could get statistics on other coffee houses or quick service restaurants and determine what is the average current ratio for a similar business in that industry. If we find out that other coffee houses have a current ratio of 1, we might be ecstatic about our current ratio. But if we find out that other coffee houses have a current ratio of 10, then we might say, well, 2 seemed good, but not so good when we look on the other side of the fence and see that the grass is greener. Either way, the building block here is bigger is better within reason. Now, the reason I say within reason, cash is not a very efficient asset. You're not going to earn a whole lot of return on investment by having a stockpile of cash like Scrooge McDuck in the comic books. You want to deploy that cash into investments or maybe to purchase equipment that you could use to run a profitable business. So I would argue that at some point a current ratio could be too high simply because you're leaving money on the table in the form of an opportunity cost. You could do something better than have a bunch of cash, just as an example. Also, inventory. It's good within reason, but having too much inventory can be detrimental to a company because inventory could spoil. If it's a fashion item, it can go out of style. If it's a technological item, it could become obsolete. So you want to really minimize your inventory within reason. Bigger is better for the current ratio within reason. The current ratio only tells half the story. I mean, let me give you an example here. What if you had current assets, let's just say current assets are equal to $2, a whole $2. okay? And current liabilities are equal to $1. That would give you a current ratio of 2.0, okay? 2 to 1, which, as we saw before, has the potential to be a very healthy current ratio. However, that only gives you working capital of $1 entire dollar. Not even enough to buy a cup of coffee at this coffee house, okay? So working capital tells us the magnitude of the company's liquidity. Sure, you have a current ratio of 2.0 because your current assets are twice as big as your current liabilities. How great. But you only have $1 of working capital because your current assets are only $2, your current liabilities are only $1. Let's erase the board here a second, and let's calculate the working capital for Blake's Coffee House. So for our coffee house, current assets are $21,300. Current liabilities, $10,200. Which gives us a working capital of $11,100. So not only do we have a current ratio that's greater than 2.0, but we can see we've got $11,000 of wiggle room. The working capital in combination with the current ratio gives you a pretty good indication of the company's short-term health, its ability to pay its obligations within the short term. One final note before we leave the balance sheet is the historical cost principle. What we're basically saying here, transactions are typically measured at their historical cost. In other words, what we paid for an item. And this is a rule under United States GAAP, generally accepted accounting principles. So in other words, this inventory that you see right here that is $600, that almost certainly represents the exact cost of what we paid for that inventory. This equipment, $18,900. That's how much we paid for it. Now, what would be the alternative to historical cost? Fair market value might be one alternative. What if, for example, you were able to purchase this equipment used and you got it at a bargain, and maybe a year or two later it's actually increased in value? You might make the argument that, boy, shouldn't we record this at fair market value, what we could sell it for? But the reason we do this at historical cost is because it's verifiable and it's objective. If you were to try to record this at fair market value, you would have to get an appraisal from somebody who appraises equipment, and that would be an opinion. It's not a set value. One person might think it's worth this much, another person might think it's worth something lower. So it's somewhat subjective. Historical cost, even if there's a trade-off between what is relevant and useful and what we have reported, historical cost is objective and it takes that guesswork out of the picture. We know that things are being recorded at what we paid for them, and there's not a lot of wiggle room there. It's very verifiable. There are instances where we might decrease the amount of the asset. For example, what if we bought this equipment and a couple of years later it became obsolete or nearly obsolete? We might choose to do what's called impair the asset. So we might record an impairment to bring the asset's value down on the balance sheet, but there are only rare instances where we would ever increase the recorded amount of an asset on the balance sheet. So historical cost, record things at what you paid for them. Occasionally, although rare, we might impair the asset and bring the asset's amount lower. And in other rare instances, we might increase the amount, but we'll talk about some of those exceptions in a later lecture.